Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, the news from the Federal Reserve this week didn't really lift the market. It basically sold off for most of the week, ending about 2% lower on Friday night. Really, the package just didn't impress investors that the Fed could rescue the situation at this point. And the CPI figures on Friday really made the question of inflation rearing its ugly head come to the forefront again, which again means the Fed's hands will probably be tied with respect to further rate cuts in the immediate future. The question that investors will be asking themselves, of course, going into the festive season will be, will the US economy really slip into recession in the new year? Or will the fact that employment seems to be holding up and even the retailers and the consumers seem to be still out there to some strength, will that be enough to keep the US economy from slipping into a real recession? We think that there's a possibility of the market going in both directions. It's a very difficult one to call at the moment. We need more data. We need to see what happens in the traditional January buying period for stocks. We still feel that the head and shoulders reversal pattern scenario we've been talking about will unfold. So let's take a look at our NASDAQ chart. Here we're looking at the NASDAQ Composite Index chart for the last 3 years. The reason I want to look at this chart today is to really point out the importance of this long-term average line. This is the long-term average over these last 3 years, and the significant thing is that the market really for the last year and a half has been well above that average line, taking now 3 tries at breaking through the line, and each time bouncing back very nicely, and in fact reaching the October highs we've seen last month before the last selling period. The selling that happened a few months ago, of course, was when the first news of the subprime mortgage crisis broke, and considerable selling at that time took us virtually down to touch that average line. We now have another sell-off period going on. Last week, of course, we had a nice bounce back with the feeling that the Federal Reserve may well cut rates again at the December meeting, but also a little bit more confidence that the financial sector is dealing to some degree with the financial crisis caused by the subprime mortgage industry. Now, the real question, of course, is whether this is going to be just a repeat of the pullbacks we've seen in the last year and a half or so, where this rally would now carry on upwards and go on to form yet one more high in this bull market that we've seen for the last 6 years, or whether, which is in our view more likely, that this is in fact the short-term rally which will be part of a right-hand shoulder forming out here of a head and shoulders pattern. This head and shoulders reversal pattern really is the left shoulder here, followed by the head of the pattern, which was in October, followed now by the formation of a right shoulder into the new year, before then, if the pattern does complete, the more likely scenario then is that the market will then drop down through the long-term average point at around about 2,500, 2,500 for the NASDAQ, and then possibly a longer term period of downtrend well into the new year. Not the best of scenarios really going into the festive season, but it's unlikely that investors will get enough good news really over the holiday period to pick the market up to any great degree. We expect the odd brief rally on thin volume days to show some investors are actually willing to buy back into this market at this point, but we don't expect any big movement until we're into January. It seems that economists are really about evenly divided at the moment in their thoughts of where the American economy is going. half feeling that we are sliding into recession, and it'll be some time before the economy really shows signs of picking up to any large degree. The other camp, of course, feeling that we're not there yet. We still have reasonably good employment data. We have a consumer that seems to be unrelenting in their appetite for spending money. So very difficult to know how the market's going to view the first quarter of next year. With the Federal Reserve now probably consigned to the sidelines for the next couple of months or so, we do feel that the ongoing credit crisis, the subprime mortgage crisis, and the figures really for the retail trade over the festive season hold the key to the first quarter. If they don't worsen, then we feel that the first quarter will be fine. If they do, then we do see the market falling again quite dramatically during the first quarter. So until next week, it's goodbye from London.